Hi, this is Linda Hitt. We're going to talk about a line of credit, which is a flexible way of borrowing money to build up inventory or do other things like that, where you may not need all the money all the time. Characteristics of line of credit is you can borrow and actually repay principal as needed, which is probably on a monthly basis. In some plans, you may have to repay principal down to a certain balance or to zero in a 1 year period of time. Interest rates can vary. If interest rates in general go up, chances are your line of credit rate will also be higher. The interest rate you pay, if you're the best corporate customer, is the prime rate, but you may not be the best corporate customer, so you may be paying, prime plus 1, prime plus 2, just adding percentage points onto the prime rate. There is a 1 year term often with a line of credit, but often it can be renewed, and companies do indefinitely, so they have it for long periods of time. We have a financial rating like a credit score as a company, so those with the best credit scores get the best rates. And interest is usually paid at the end of the month. We can borrow or repay at the beginning. I'm sure that varies some depending on the bank that we're dealing with. So let's take a look at our example now. We have just a short one to look at with some journal entries and the impact calculations. So September 1st, we take out our line of credit. Even though we're granted up to $50,000, we're only borrowing $15,000. Just to make it a little bit different, I'm going to call it line payable, but certainly it's a liability. So if you borrow some on your line of credit, of course your resources go up as your assets, but you also have more liabilities. Stockholders' equity doesn't change, nor does the net income. And line of credit, I guess if you're borrowing this directly because of inventory, this could be considered operating to keep you going from month to month. If you're using a line of credit, I don't know, I guess you always use a line of credit for daily operations, where usually notes payable, sometimes you're borrowing to buy equipment or do something that deals with financing. So we'll leave that alone. And at the end of the month, we're making our payment. And we are told that prime rate is 5% per year. It's an annual rate. And the company qualifies for prime plus 2. So we're not the best corporate customer, but we're not a bad company either. So the principal, well, our calculations will be $15,000 times, and 5% plus 2% gives us 7. So we'll do 7% as the interest rate. And then this time it's monthly, so we do want 1/12. So 7% is an annual rate. So if we take $15,000 times our rate times 1 divided by 12, $87.50 is the interest. Since we're paying every single month, we don't have to accrue the interest. It's an expense and it's paid in the same period. So $87.50 is the amount. We may decide to round later. It is rounding. Let's format that to 2 places. Okay, there we go. Paying interest is no surprise. Your assets go down. Your retained earnings is less because of the expense. So stockholders' equity goes down. Your profits go down. And last but not least, your cash flow is less, and it's because of operations, because it's an expense. Let's set up, and I'll go ahead and change that to line payable. It basically is a notes payable. Whoops. Okay. So we'll post the $15,000 there. The interest, of course, every month goes in. Then we go on to next month, and we discover we borrow $10,000 more. So we'll do cash, and our debt continues to rise. Pick that up. The I guess because I did the cents takes up more space. Same impact as we had in the first entry, so I won't worry about the impact part of it. But our line payable, our liability goes up, so that now the balance, if we did a balance, would be 25,000, right? If I simply take 15,000 plus 10. Whoops, hit the wrong button. $25,000 is the balance. So now when I do my calculation, it's going to be 25,000. Then you've got to check and see, did the interest rates change? And I don't see anything paid here. Oh, they did. Okay, 5.5%. And remember, we're prime plus 2. So 5.5 plus 2% would be 7.5%. So 0.075 times 1 over 12 should be the new amount of interest. So the principal's gone up, so I'd expect more interest, and the interest rate's gone up, so I'd expect more interest. And then 1 divided by 12, or just simply divide by 12. Kind of doing it the long way. 156.25. Okay, 156.25. And no surprise, it's the same titles. So I will just cut and paste those. Okay. Next, we're going to repay some of the line. You know, we build it up to buy inventory, and then later, as we get money in from customers, we can start paying off our loan. So that's the nice part about it. We don't have to, you know, borrow the amount for the full length of time and then be paying a lot of interest on it. So if we reduce our principal this time for 8,000, then our debt comes down. So we have 15 plus 10 minus 8. So that's 17,000. So if we do the interest calculation, it's 17,000. And then we'll check and see, did the prime rate change? And it says it does not change. So it stays at our rate stays at 0.075 times 1 over 12. Okay, so we then do the calculation. 17,000 remaining principal at this point times 0.075 divided by 12. Let's do it that way. 106.25. Okay. 625, 106.25, and I'll just cut and paste it down. We're again paying interest. Okay, and then December 1st we repay more. So I'm going to take the titles. You're reducing your liability for 10. And I wonder when we made the first repayment, I didn't show the impact, and I probably should, because your assets will go down, your liabilities will go down, and your cash flow also goes down, and it continues, of course, to be operating. Okay, so we've repaid $10,000, and I slipped the digit, looks like. Let's put another 0 in there. So up here, this is going to go down by 10. And if we do the math, we've got the credits are 15,000 plus 10. So we originally had up to 25,000, and we repaid 8, and we repaid 10. So now we're down to 7,000. Okay, so put 7,000 down as the remaining principal. And the interest rate did drop. The prime rate went down by 4.5. We're prime plus 2. So add 2 percentage points, and that's 6.5%. So here, not sure why that did that, but anyway. I'll just move it over. Okay. So times 0.065 times 1/12. Whoops. And that sure didn't come out. 0.065. I left the O off. Okay, I guess that's good enough. So 7,000 principal remaining times 0.065 interest divided by 12. Unfortunately, it comes out to an uneven, but we'll just make it $37.92. So 37 cents, $37.92. Okay, 37.92, 37.92. And that's that. So you can see the pattern. You know, you borrow when you need the money, you repay when you don't need it, and basically the principal is going to change as you borrow and repay. Though by the end of the year you may have to pay off all the principal over some set period of time, and then the interest rate changes. It can go up or down, and your rate may not be the best corporate rate. Your rate may be something different, but the entries are pretty straightforward. You know, liability goes up, liability comes down, and then every month you pay the interest. So the only good thing is that you do not have to accrue interest if you pay it on a regular basis. So it definitely, you wouldn't buy a building or a piece of land with a line of credit, but it certainly helps to do, your inventory build up and so forth. It's a good basic tool.